Good evening, everyone. Welcome to Indawas webinars. My name is Yuling, and I am the investment lead at Indawas. Today, we are going to cover the topic of hunting for passive income amid high inflation. And we are very excited to have two guest speakers with us today from two global and leading fund managers in the world. So we have Ross from Aberdeen and Alex from JP Morgan. Before I get into today's content, Ross and Alex, do you want to introduce yourselves first?
Yeah, sure, Yulin. Thank you very much. Yes, my name is Ross McSkimming. I'm one of the senior investment specialists at Aberdeen. I've been with the firm now for 22 years, and today I'm really excited to talk to you about our income capabilities.
Thank you, Ross. Thank you, Yulin. My name is Alex. I'm equally excited to be here. I have been on the buy side for 27 years, and I've been in Asia since 1996, having moved country 7 times in that period. So I'm thrilled to be back in Singapore at the moment. So as a spokesperson for Asia and emerging markets in this session, I'm just thrilled to be part of this region and to be talking to you now.
Fantastic, and we're really looking forward to hear your insights on the market and in particular on dividend investing tonight. So briefly on what we're going to touch upon today, we will obviously have a very quick market review on the current environment, and then we will also talk about whether dividends are affected in this environment and the opportunities and risks of dividend investing. And finally, we will go deeper into how to create a passive income portfolio that will meet your investment goals. So these are some of the disclaimer that we have to show from Indawas and Aberdeen, as well as JP Morgan. I think it was before. Yeah. All right. I think I've done my job. And just a quick flash of the Slido link here. Essentially, this is a page where you can go and ask all your questions that you want. So please do go ahead and post any questions that we will address at the end of the session. So quick introduction of Indawas before we get to the meat of the session. If you don't know about us, we are a fee-only wealth platform and the first digital wealth advisor for all of your money, including cash, SRS, and CPF. We are backed by leading global strategic and venture shareholders, such as SoftBank, UBS, and more local names, including Singtel and EDBI. And we are really focused on doing the right things for our clients. So by focusing on advice, access, and cost, we maximize the chance for our clients to achieve their financial goals. Let me start from cost. Our platform uses funds from global fund managers. And traditionally, if you buy an investment fund from a bank or IFA, you will be charged layers of fees, including sales charge, as well as trailer fee, which is essentially the commission paid to the bank as the middleman. And we have revolutionized the model, and there is no sales charge, no transaction fee, and we rebate 100% of trailer fees back to clients. I am confident to say that we are one of, if not the lowest cost platform in Singapore. Additionally, we provide access to institutional share class funds so that we can give access to really good quality funds at the lowest cost possible. And finally, because we don't take any commissions from fund managers, we are actually agnostic to what fund managers we partner with. And we are laser focused on choosing the best products from all the fund managers around the world. So we partner with, more than 50 fund managers who combine manage over 20 trillion of assets. And today we are very thrilled to have JP Morgan and Aberdeen with us. For them to actually share their expert insights with us. So we have a special promo today. This is a QR code where you can scan and get $20 off your Indawas fee. Don't worry if you need more time to think about it and consider. I will flash this page at the end as well, and we will also send you a follow-up email with this promo code. So the spotlight today is really our two partners today, Aberdeen and JP Morgan, and their expertise in dividend investing. So with no further ado, Ross, I will hand over the time to you first to give a quick introduction of Aberdeen.
Thanks, Yulin, and a lovely introduction there. So to those who are listening in, first of all, we may have had a bit of a rebrand, but Aberdeen has built a really strong reputation as a leader in Asian markets, particularly in equities, in key areas such as sustainability, income, and smaller companies. But we're also a specialist as well in developed markets with a real strong product suite across income, sustainability, small caps, and into thematics as well. Now, we manage over $500 billion of assets under management, and round about a quarter of that is in equities, which gives us really good insights into today's topic. For those that you know as well, you'll know that we only invest in better quality businesses, and engagement is a key part of what we do as well, where we have very strong ESG credentials. On the next slide, you can see we have a very broad team as well. We have 120 equity investors based in 13 different locations around the world. Specific to the Asia region, we've got a hub there, or several hubs of 44 portfolio managers. And we've been investing and have offices in Asia for over 3 decades now. And having that really strong research base is an important component when it comes to investing for a global strategy as well. It's important to have people on the ground to understand what's happening and to understand companies. I'll pause there.
Thank you so much. Alex, it's really good to have you here again. We had you with us earlier this year, and you also gave an introduction to JP Morgan. Would you mind doing that again for us today?
I'd be thrilled. How sweet of you. So JP Morgan is a very big American bank, but the asset management business on its own is an extremely large entity. And I work for the emerging markets and Asia Pacific team specifically. Now, there are 3 bits of information to take away from this slide. So the first is that we've been doing this for a long time. So our oldest strategy in the emerging markets and Asia Pacific suite goes back to 1969. The next thing is that we have a lot of resources, and I'll talk a bit more about that in a moment, but we have around 100 investment professionals just looking at emerging markets and Asian equities. So we're very, very well resourced. And then what you can see on the map is that we've got investment centers in multiple locations. And what we're trying to do there is get the best of 2 worlds. The first is to bring a global platform, global resources, a global way of doing things to this asset class. But we also want local expertise. And by way of example, in the Greater China region, we have 16 dedicated Greater China analysts, all of whom speak Mandarin, based in Hong Kong, Taipei, and Shanghai, just looking at Chinese equities. So we're trying to get breadth and depth. And on the next slide, very briefly, I've given you mugshots of our research team, because of course the fund managers like to think they're the center of the world, but actually underneath the fund managers, we've got this really, really robust investment platform. And just by eyeballing this, you'll see that this is a very diverse group. So we've got, I think, something like 17 languages spoken amongst this analyst team. We've got 1,700 companies covered across emerging markets and Asia Pac. And these are the investment ideas which get shared to help drive our different investment strategies, including EM Dividend.
Great. So breadth and depth, and I see both of them in both of you. Now we would like to hear from you the most recent updates and outlook on equities market. So this year has been a crazy ride, and we might not be out of the woods yet. Where are we in the cycle? Where do we see tension and maybe bright spots in the equities market? Ross, would you like to start us off?
Yes, Yulin, thank you very much. Yeah, you're not wrong. It has been a bit of a roller coaster, and certainly that level of uncertainty around the outlook definitely remains elevated, especially in Europe. We know what's going on. There's a war going on where there seems to be no end to a ceasefire, and so a recession increasingly looks likely, certainly in Europe, as we head towards winter. With the energy crisis that's going on, that's only going to intensify there. Inflation around the world, again, that remains elevated. but clearly central banks are committed to bringing that inflation under control. But despite the fact of what that may do to growth rates, and that's certainly been impacting equity and bond markets. But there's a lot of good data points there to show show where we're at the moment. It's not all doom and gloom. When I look at the recent quarter-over-quarter results, it's essentially suggesting that dividend growth of around about 13% year on year. And that's even set against those inflation rates that we spoke about. Indeed, since the 1970s, companies with high dividends or high dividend growth have really outperformed in these periods of high inflation. However, we do believe that equity income is relatively well placed, given the comparatively steady income stream that dividends can provide. And this is often reflected in dividend-paying companies' share prices during such times. Again, look at the earnings of these companies. Q2 earnings have proved fairly resilient as a whole for companies. When you look at the holds versus in the companies that we hold. So, when you look at the beats versus misses, what we are seeing in the types of companies that we're holding, it tends to be on a basis of around about 3-1, which means that companies that are beating their earnings expectations, it's around about 3-1. So, in terms of ratio, that's looking fairly strong. On the next slide, in terms of where we are with valuations, we can see that global markets, and I'm using the All Country World Index as a proxy here, we can see that global equities are looking relatively cheap compared to the 5-year average. So what this is really saying is, the market is effectively looking cheap, and I would say that this is quite an attractive entry point for anybody who's looking to invest in global equities today, just given that optically they are looking cheap compared to its 5-year history. I'll pause there.
Thank you, Ross. And it was very encouraging to hear that, dividend kind of oriented stocks tend to outperform in this environment. But I guess the caveat is that you need to pick the right dividend stocks, right? So the stocks in your portfolio have obviously delivered good earnings, but not all the dividend stocks would have done the same, highlighting the importance of, again, stock picking.
Absolutely, I would 100% say that is the right approach there. You need to be quite discerning. Not all stocks are equal, so you need to very carefully select which ones you want to invest in.
Exactly. Great. So that's on global markets. And Alex, you're representing the emerging markets today. Want to hear your thoughts on, how does emerging markets looking like, and whether there are any opportunities or risks in this environment.
Of course, well, there are always risks and there are always opportunities in investing. That's the beauty of it. And I think that on my first slide here, Ross has already addressed some of the issues very clearly. Tragically or disgracefully, one of the markets within emerging markets has invaded another one. And of course, one of the effects of that has been that it has been inflationary. And so the high inflation we were seeing anyway, as most of the planet moves towards end COVID, has just been exacerbated or exaggerated by what's going on in Eastern Europe. Now, one of the things about that, and I know there's a lot of very financially literate people on this call, so one of the things about that is if you think about emerging markets as if they were a DCF, a discounted cash flow, is that rising inflation is causing interest rates to go up. And higher interest rates or higher discount rates means that longer duration assets or growth stocks will typically perform worse than shorter duration assets or maybe income stocks. And so although a lot of the world has been in love with growth stocks for many of the past few years, in a rising interest rate environment, this is quite a good reminder that actually income stocks play a very, very important role in portfolios as well. And then the third thing in emerging markets in Asia is China. Now, China is always fascinating to talk about because it's big and it's exciting and it's complicated and it's dynamic. But there's something else, and we'll go to the next slide, please, which is that China is doing something quite different at the moment, and I will explain why. So, to keep things simple, because it's a Thursday evening and everyone's tired, we have two immovable objects in China. The first is zero COVID. And Xi Jinping will not back off on zero COVID at the moment. And that is just, that suppresses growth. The other thing is that China, however, needs a high growth rate, because this is how you keep on bringing people out of the rural class and into the growing middle class, which is so important to the political system there. And if you start with zero COVID and you end up with whichever growth number you want to get to, the only way between the two is to ease. So we've got very high level of conviction that China will carry on easing monetary policy. We've got very high conviction they will carry on boosting the fiscal side of things. And we also think they will keep on easing off on the regulation, which had been such a big part of markets over the last couple of years. And that all sounds quite obvious, but if we put that in a global context, every day when we open a newspaper, we turn on the news, what we read about is interest rates going up. And what we have in China is the opposite. So this is how diversification works. This is why this is such an interesting thing, is we've got one really large part of the asset class, which is moving differently than everyone else. And that's something that I think we can celebrate.
Great, thanks for all these analysis. And I think I definitely resonate with you on the importance of allocating to non-growth oriented stocks to diversify your portfolio so that you are not loaded on kind of longer duration assets in this kind of environment when it really hurt. And let's move on. I know that a lot of the people on this call would be very interested in kind of the dividend aspect and whether it's still holding up. I think we have kind of alluded to that a little bit before on kind of the status of companies paying dividends. But maybe just to touch a bit more on this topic, has the recent equity market weakness affected dividends? So Ross, over to you.
Yeah, like you say, Yulin, we have definitely seen resilience when it comes to companies continuing to pay dividends. Dividends, I would say, are in abundance there. The big number you can see on your screen there, $1.3 trillion were paid out by global companies. These are the constituents that make up the MSCI All Country World Index. And there's thousands of companies that are paying dividends. And, that's totaling around about $1.3 trillion. And that is the sort of dividends that, we are chasing, that JP Morgan are chasing. And certainly over the last 12 months, we have definitely seen resilience in that. And that's what makes investing in income and dividend paying funds quite compelling. And when you see on my next slide, you can break that down onto a sector basis as well. So again, this is the year on year in key sectors. We've seen growth in areas like material, energy, and consumer discretionary, where we've seen a big uptick in the availability of dividends. You can see at the bottom end of that chart as well, around about, you can see utilities, comm services, consumer staples. That's probably more a factor of the types of stocks that are in these types of sectors. In particular, I'm thinking of comm services. It was a bit of a negative year on year, but again, when you think of some of the constituents where you have companies which have become increasingly large but perhaps didn't pay a dividend, I'm thinking about Meta Platforms in that sort of space. But overall, you can see there right in the middle on an all country world basis, we've seen round about a 12.7% increase in dividends from last year to round about the middle of this year. And you can see that again on the next page as well, how it splits down regionally, where again, you can see that all country world growth around about 12.7, we know that. But, year on year, we've seen 20% growth in Europe. That's important for the Aberdeen strategy, and I'll talk to that later. But you can see there has been healthy growth. Clearly, LATAM is a standout growth in dividends, but that is really more a factor of the fact they're coming from a very low base back in 2021, just given the constituents of the LATAM markets, where they're very commodity driven.
Great. Alex, do you have anything to add?
I do. Now, this chart there's quite a lot of color and data on here, but let me take you just to the key point. So this shows the driver of returns by region for the year to date. And emerging markets is over there on the left. And what you can see is that the key negative driver of returns, or the key reason that equity markets have been falling in emerging markets, isn't so much because earnings have been declining, although they have a bit. It's been that valuations have got cheaper. So the markets are paying a lower multiple. This is the blue part of the vertical bar. Markets are paying a lower multiple for any given level of earnings now than they were at the start of the year. And although that's the sort of thing which makes investors often very uncomfortable, if you take an analogy of being in a supermarket, if you're in a shop and things are getting cheaper rather than more expensive, that's something that you look out for. That's something to celebrate rather than something to worry about. And to some extent, this is what we're seeing in equity markets. But the other key point on this page is that yellow piece of the bar. And that is the portion of returns which is driven by dividends. And what you can see here is that whatever else has been happening to emerging market currencies or to earnings or to valuations, etc., is that dividends are a constant, and they're a positive constant. So I think it's a very strong reminder that this is like ballast in a portfolio. This is like a foundation in a portfolio. And you should always remember that whatever's happening in the market environment, there's room for some growth in any portfolio, but there's also room for some income, because this is what will give you some security when other things are less comfortable.
Yeah, very good point, Alex. And this chart is a very powerful illustration of, I guess, the consistency of dividend even in this environment, and how that would continue to be a reliable source of income for income investors. So moving on, the next question I have for you then is, why do you think investors should or should not consider allocating to dividend strategies? Now, or in the longer term, like, what are the benefits or the, I guess, disadvantages, if there is any, that you want to highlight to the audience on this webinar? Ross, do you mind starting us off again?
Yeah, so clearly I think there's added advantages for investing in a dividend strategy. Alex has already pointed out there is resilience in these dividend payments, and that's shown quite nicely on this chart as well. So this goes back to 2017. So you imagine in that intervening period between 2017 and today, clearly we've gone through some big macro events, and we have gone through COVID, and the implications of what's happened with COVID. When we were in the worst of that, certainly in the UK and in Europe, we saw regulators impose caps on or bans on dividends in the banking sector. That aside, you can see on this chart that there's been companies have continued to pay dividends despite the macro conditions, and I think that would be one of the key benefits of that. And back to Alex's chart where he was showing the yellow, there is that continued payment of dividends, and it does form part of an overall portfolio. And if you were just to flick to my next slide, Yulin, you can see there that in terms of the total contribution, so I've split this down by market, whether it's the USA, whether it's the world, or Europe, or Japan. You can see that across these different markets, that dividends form a very significant part of a total return. It's 40% in the US, it's 50% on a world basis, and in Europe, it's almost 70%. So what we're trying to say here is, in the context of a total return package, you could, if you want to reinvest your dividends, the compounding effect of reinvesting your dividends makes an income strategy very interesting from a total return perspective. And I know that if you were to show how our fund compares on a total return basis against a broader universe of non-income paying strategies, on a total return basis, it looks very attractive. So depending on whether you actually want to receive the income or if you want to reinvest that income into the strategy for a total return, both are valid propositions for you here. But I think overall, it's the resilience of companies paying dividends and the availability of these for us to participate that makes the asset class really attractive for investors.
Great. How about on emerging markets? Alex, over to you.
Well, Ross has just very clearly explained the argument for income or for dividends. And I agree with everything that he just said. And so maybe one of the next questions to ask is, well, why would you want to invest in dividend in emerging markets specifically? And I think there's a couple of things here on this slide. The first thing is that we've managed to get, I think, this far through the presentation without talking about ESG, but it is one of the hot topics on everyone's lips, and it will remain so. And of course, companies which are willing to share their cash flows or their earnings with investors in the form of dividends, that's one sign of good governance. So that's something to be encouraged by. The second thing is, as you can see on the second bullet point here on the slide, is that by combining income and growth, we do get a powerful driver of total returns. And one of the things we know about emerging markets is they are going to grow for the longer run. They do have so many exciting opportunities as consumption levels rise, as the middle class grows, as people buy more things, and as companies evolve to service those needs. So the growth is there, but sometimes we just want a slightly calmer ride, and income provides that. And then I think that the next thing actually is on my next slide, please, which is there is an old investment adage. And what it says is that the more stones you turn over, the luckier you're going to get. If you're looking for something exciting underneath the stone, the more stones there are on the field, the better the news is. And what some people I think are surprised by is the extent to which dividends are available in emerging market equities. And so what you can see here, and this is as of the end of August, so it's very, very current. If you want largish companies, but with plenty of liquidity, there are nearly 900 stocks in emerging markets, which will give you a yield of more than 2%. And there are more than 400 stocks, which will give you a yield of more than 4%. So I think we can agree that the asset class is interesting, yield investing. I think we can agree that we're excited by emerging markets. And actually, if you want yield in emerging markets, there's plenty to choose from too.
Yeah, that's a very good point. So just kind of to summarize what you said, there is still, plenty of dividends in the market, even in this environment. And global market is honestly predominantly dominated by developed markets, and that's a good place to look for dividends. But even in emerging markets, you can actually get probably a diversifying source of income from a different set of companies, and that's still a very large universe for you to choose from. And they are generating a good amount of yield for income-seeking investors. And additionally, from what I heard, the fact that the companies are able to reward their investors by paying dividend is a sign of good governance. And that is a good fundamental signal, I guess, for investors. So now that we have touched upon, I would say, pretty broad aspects of dividend investing, I want to get us into the weeds a bit more and start thinking about how to build a kind of a passive income portfolio, as is termed by, I guess, the Singapore investors, because I guess we're all a bit obsessed about passive income here. But from an asset allocator's perspective, I believe that a robust passive income portfolio needs to incorporate multiple diversifying sources of income streams, including both equities and fixed income. I saw that someone has already asked a question on fixed income market. So clearly people are thinking about that for income investing, and that is great. But before I go there, I want to pick your brain, Alex and Ross, on how you would construct an equity dividend portfolio to deliver a sustainable and attractive level of dividend income. Ross, again, if you would like to start us off with your kind of global market perspective.
Sure, and I will reference the global dynamic dividend capability that we have at Aberdeen. This is a diversified source of income for investors, and I'll talk you through how we think about dividends and how we think about investing for the strategy. So this is something that's not really new to us. We've been doing this for a long time. We've got around about 1.4 billion in this particular strategy, so we're very experienced. It uses, you were talking about passive. We take an active management approach to investing, and ultimately we are targeting a premium and stable dividend stream of round about 6% per annum. It's anywhere between 5 and 7%, but it's round about 6.5 at the moment. And we want to pay that out monthly, or you can opt to reinvest that, but ultimately we want to pay out a very level stream of income to our investors, and we want to have that consistency. Now, how we go about doing that, there's two parts to this particular strategy. There's a core part, around about 80 to 100 stocks, and then there's a dividend capture sleeve, which I'll talk about in a minute. But it's the dividend capture element that makes this strategy differentiated. One of the key things that we really want to make sure is that we don't want to erode investors' capital. That has to be a key consideration for us. So we want to ensure the delivery of that yield, and I'm talking 5 to 7%, but we want to make sure that that's achievable and sustainable without eroding investors' capital. That's the key to us as well. So on the next slide, the detail that sits in behind it. You know, what we have is 95% of the core portfolio would be a very standard income fund. But in terms of the types of stocks that we invest in that, we have got a really good mix of stocks that are high dividend. So you would almost call them high dividend value stocks. But we also have a good mix of low dividend growth stocks in the portfolio. So I talk about wanting to grow investors' capital without eroding that. So we have growth stocks in there. So in that 80 to 100 stocks, we will have stocks in there like Alphabet and Microsoft and Apple. You know, these companies either pay no dividend at all or maybe even a small dividend. But we really like them in this portfolio for its growth characteristics as well. So that it helps us build on the NAV of the strategy as well. And we want that fund to be very well balanced, where we have around about 60% in value, 40% in growth. So it's, you know, it's not taking excessive levels of risk in the portfolio as well, but it's giving you some income. So the core portfolio will contribute round about 40% of the overall dividend yield. It has a running yield of around about 3% at the moment, but that's a very standard core portfolio. The bit that is really quite exciting and where we differentiate ourselves is in that 5% there that you can see at the top of your screen. So a very small part of the overall portfolio, but this, if you think about it in engine terms, this is your turbocharger. This is paying in the region of around about 50 to 70% of the overall yield. And it does that by rotating through 50 to 80 dividend events each year. It's very uncomplicated in its nature. We know that companies pay dividends and we know that they pay them on a regular basis. Sometimes they'll pay special dividends, but typically they will pay regular dividends at the same time every year. And what we look to do is through our dividend capture sleeve, this 5%, we will rotate into these stocks, capture the dividend, exit that stock and move on to the next one, and so on and so on. So as I say, that is really paying the bulk of the overall yield. It's got one job to do, which is to collect income. And so that has allowed us to be able to deliver a yield of round about 5 to 7%, as I said, and it's done that without eroding capital. And if you just flick to my last slide, Yulin, you can see the sector and country exposures of the fund. Now, we don't want to take excessive levels of risk. We are not just investing in high yield stocks. You know, you can see there on the various sectors there as well that, you know, some of our peers may just have high dividend sectors like financials or communication services, utilities, and consumer staples. But you can see there we have far broader exposure in our capability, which I think is actually beneficial to our investors, just given that we are accessing growth sectors as well, like technology and healthcare as well. Again, on a country basis, you can see that we don't want to take too much excessive levels of risk as well. So we're broadly in line with the index, but it is that dividend capture sleeve that is making the difference. So hopefully that gives you a bit of an insight into how we're building the portfolio. We do tend to avoid investing in complicated derivatives to boost income. We don't do that. We don't need to do that. We would much prefer this dividend capture sleeve where we're simply moving into a stock and coming out of a stock, collecting the dividend on the way. And that allows us to be able to pay a nice premium yield. I think the yield at the moment is around about 6.5%. And if you were to compare that, that compares very favorably to other asset classes. Whether that's emerging market debt or high yield or corporate bonds, I would say this is a very attractive dividend stream for your investors. And I'll pause there.
Thank you, Ross. And you mentioned that the dividend capture sleeve is a very simple sleeve. I would say it still requires a lot of skills and, to know when to buy and when to exit. Let's move on to Alex to talk a bit more on just the emerging market sleeve and how investors should think about kind of creating an income portfolio for emerging markets.
Great, thank you. Well, I think before we talk through this slide, there are maybe 3 key things that we bring to our philosophy when we're trying to build a yield product. The first thing is to be very, very fundamental. And although we've talked about things like geopolitics or inflation or what's happening at policy levels within China, ultimately, with all of those analysts on one of my first slides, the advantage we think we have is by getting a better idea than the broader market about individual companies, being very fundamental, very bottom up, and just picking the best stocks for this particular strategy. So that's the first thing. And it's, by the way, it's one of these things which is easier to say than it is to do. So we spend a lot of time trying to get that right. The second thing is consistency. And that's in a couple of different areas. We're very consistent that all the stocks in the portfolio pay a dividend, some more, but some less. And this is so that you know that it is what's going on, sort of it is what it says on the tin. But also we make sure that we keep that approach consistent through market cycles. So when growth stocks are outperforming, we don't move our income stocks into growth just because that feels like a good idea at that point in time, because then you don't know what you hold. We will always be an income portfolio. And that consistency through time is very, very valuable because it means that we're going to perform well in market environments like the one at the moment. And although we might lag a little bit in a go-go bull market, we're doing it for reasons that people can acknowledge and understand. And by the way, all of the income that we pay out of the portfolio comes from yield generated into the portfolio. So we're not realizing capital to pay dividends or anything like that. And I think that the final core tenet within the portfolio is around diversification. And both Ross and I have mentioned this already, but you should never have all of your eggs in one basket. You should never only own growth stocks. You should never only own income stocks, I would suggest to you. But then even within an income portfolio, it's possible to diversify. So as for where we are at the moment, if you want to know what a PM thinks about the world, the best way to understand it is by looking at the portfolio that she or he manages, because that's how they express themselves. So you can see that we've got nice sector diversification. We've got quite a lot of staples. And of course, staples can be a more defensive place for us to invest money when we're going through tougher times, because people will always have to buy food. They may always choose to buy beer or something like that, but they don't have to buy air conditioning or cars. And so that's a more secure revenue stream. We've got some IT. And I think that's quite a good reminder that even in an income fund, even in a fund which might have a more stable growth profile, you can still buy some really cutting edge companies which have got part of this longer term growth that we like. And then we've got a good selection of financials. And the number above each bar on this page tells you where we are relative to benchmark, but the number underneath each bar tells you what the absolute portfolio exposure is. And you can see that nearly 30% of the portfolio is in financials, and financials are unusual in that while many other businesses suffer in a rising rate environment, the right financials can outperform. So we're quite confident on that. And then at the country level, well, we've got quite a big overweight in Mexico. We've got an overweight in Hong Kong. We've got an overweight in Indonesia. You can see we've got an overweight in South Africa. So geographically, we're finding companies which are exposed to all of these different parts of the world. And then where we tend not to have so much exposure will either be in a market like India, where companies are growing so quickly that they would rather invest capital into their business rather than pay it out, or a market like South Korea, where for governance reasons, the Koreans just prefer to pay fewer dividends, which creates a challenge for us. And when we bring this together at the portfolio level, on the next slide, please, Yulin, what you can see here is then we get a a nice spread. So the core of the portfolio sits in names which will give us some of this growth that we want for emerging markets at the same time as paying a yield along the way. But we also want, a little bit like Aberdeen, we want something a bit more than that. And so we've got some stocks on the left-hand side which have got a lower yield, but we accept that because we're confident in the dividend payout and we know that they're growing sufficiently quickly that we think they will give a good total return. Now, we don't have any stocks which don't pay any yield at all, but we do have some of these growthier names to give that little sort of kicker to an emerging markets portfolio. And on the right, as the balance to that, we've got some higher dividend yield stocks, and these might have less growth. So you wouldn't only want to own these in a portfolio. Then you've got a sort of a fairly boring bond proxy portfolio, which might not behave like you expect it to, but they're going to have less growth, but a higher yield just to bring up the overall yield level in the portfolio. And if you do only one of the things on this page, I think you're missing out. We choose to do all of them at once and think about things as in portfolio terms in this way.
Great, thank you, Alex, and thank you, Ross, on the insights. It's really a lot to digest, to be honest. And to do all of this, you really need a lot of resources and time and expertise to cover, all the countries that you look at, Indonesia, Mexico. So let me just summarize. I think you mentioned, really a very well diversified portfolio within emerging markets and within the global kind of universe. And you need the skills to capture dividends and to select the right stocks, a lot of fundamental analysis there. And also you need a robust portfolio that captures both income and growth so that you kind of get the best of both worlds. You get income while enjoying kind of the capital appreciation from investing in equity. And that is really powerful in the long term. So now I would like to put dividend stocks into the big picture of asset allocation. And this chart shows kind of the trade-off between yield and risk that investors will take on when investing in different asset classes as well. And for example, if you look to the right, actually dividend stocks, they do have, decent yield, but it is also higher on the risk spectrum. In comparison, let's say fixed income would be kind of lower risk, but of course the trade-off is that fixed income, they pay coupons and they don't really have much of a growth potential in the long term. So I think the takeaway here is that investors with an income objective all have different levels of risk tolerance depending on where you are in your life. And instead of going for just one asset class, like, just equities, just stocks for all of your income, without considering whether this is actually suitable for your risk tolerance, investors should actually consider combining different asset classes together to get to the risk level that you are comfortable with. So at Endowus, we understand that there is a need for income among Singapore investors. Therefore, we have partnered up with fund managers like JP Morgan and Aberdeen, and we used their funds to create multi-asset solutions that are suitable for different income needs of our clients. And just a very quick overview of what we have so that you can kind of compare and, think about them. We have 3 pre-constructed income portfolios intended for different groups of people. So we have stable income that's 100% fixed income. It is really meant for those with, I guess, a more conservative risk profile if you are planning for your retirement or if you're already in your retirement. And the current target payout is between 4 to 5% with, I would say, pretty limited capital appreciation potential. Now we have higher income, which is, of course, higher paying and is really meant for those who, I guess, are still working adults with kind of income and time is still on your side. So you can take more risk. Therefore, there is about 20% equities allocation in this bucket, and there is a moderate long-term capital appreciation potential. And finally, we have future income. This is a very interesting portfolio with, 60% in fixed income and 40% in equities. And it's really for, I guess, even the younger people who would like just some, pocket money because it's not giving you a very high payout. It's only 3 to 4%. It's decent, but it does have a higher potential of capital appreciation in the long term. And here we're very transparent, we show all the data, the performance, and this year so far, all three portfolios have been down as expected, because the market is, we are experiencing one of the worst period for fixed income market in particular, like in the past century. So the portfolio is down, but it's performing as expected. And because of this, actually, because of the headwind on price and on the rising due to rising rates, the portfolio yields have been inching up in line with the rising rate environment, and it is closer to the upper end of the target payout. So even though the price is down, the portfolio has been fulfilling its income targets consistently month on month by paying a dividend, a payout out to the investors every month. And let's just conclude, and please don't forget to put your questions in the Slido page so that we can address it. So we have observed that a lot of investors are currently either sitting on the sideline, being too scared to invest, or holding cash to be more attractive in this environment. This is very human, and it is okay to do it for a short while, but this is not a strategy that will get you where you want to be in the next 5, 10, 20, 30 years. And out of curiosity, I went to get the historical Singapore bank deposit rate, the inflation rate data, and the return of a 60% fixed income and 40% equities portfolio. And I plotted this chart. It's very powerful because it shows you how you would have done if you have put your money just in bank, and that's the orange line, or if you have invested in a 60-40 portfolio from 30 years ago. So the truth is, the bank deposit rate can barely help you beat inflation in the long term. It is just too low. And even now, I was just looking up on, SingSavers and MoneySmart. Even now, the 12 months fixed deposit, that means you need to lock up your money for 12 months. It's only 2.5%, or even lower, around 2% if you have a lower minimum. And the inflation rate now is 4%. So it's not good enough. Whereas if you have invested in a relatively conservative 60-40 portfolio, yes, you see there is volatility between the years, but you would have grown your money substantially more over the years. So on a rolling 1-year basis, only 35% of the time, cash has outperformed inflation, whereas 74% of the time, a conservative portfolio has outperformed inflation. It is really tempting to stay in cash for safety, especially now. But eventually, you need to think about investing your money, and you would never know when the market would turn, and you don't want to miss that turn. So if you do have cash flow needs, and you might feel like, I don't want to, lose my money now, because I have liabilities, I have, mortgage to pay and tuition fees to pay. Maybe income strategy can be a good place to look at, so that you stay invested in the market, but you can still meet your regular cash flow needs. Again, I'm just flashing this promo code for you, and I will kind of leave it on for a while we go to Q&A. So we have received a number of questions, and we have about 10 minutes left, which is a good amount of time for us to kind of go through the questions. So let's just dive straight in and answer some very exciting questions. I have a question for you, Alex. There is a question on EM currencies. So the question is, isn't EM currency on the downside with potential crisis emerging? What do you think?
Well, I'm quite sensitive to that question because I'm from the United Kingdom, and it seems to me that if there's any market which is having a really tough time there, it might be where I came from, and the UK might yet become an emerging market, but it doesn't think of itself as one at the moment. Look, there is clearly an issue with some emerging market currencies this year, but I would actually restate the equation as saying that this is about the strong dollar. This is not an emerging market currency issue. And joking aside, if we look at what the yen has done, if we look at what sterling has done, this is by no means limited to emerging markets. The other thing I would say is that emerging markets are in much better shape in aggregate than they were in previous points in the economic cycle. And I was back a long time ago, I was a young man in Singapore in 1997, 1998, and I remember the Asian financial crisis, and I remember how that played out. And this feels utterly, utterly different. And one of the reasons, of course, is that if we look back to COVID, emerging market and Asian central banks were much more cautious actually than their developed market peers in terms of fiscal expansion, in terms of what they're doing with monetary policy. So clearly what we're going through at the moment is somewhat uncomfortable, and there will be some landmines going off, but we're not so worried about what this means for emerging markets at the moment. And the final thing I'll say is that we can never forget about the valuation. And to us, the US dollar looks expensive. So at some point, this will turn. Now, I don't know when that'll be, and I don't know what the trigger will be, and I think it's very hard to forecast those things. But so long as we can keep on finding the right companies, which in the long run will give us growth and yield, that's what we come back to. And in the meantime, this doesn't feel like an emerging market crisis to us.
Great, thank you, Alex. I see a few questions kind of Endowus related, more kind of platform related questions as well. I think one thing I would like to address is on distribution capability on our platform. So previously, you are right to say that you can't take dividends out on our platform if you buy a dividend paying funds. This has changed. So our product team has built in a function for you to get the payout. If the fund is paying on a monthly basis, then you will be able to get it either in your Endowus cash balance, or you can even pay it to your bank account. So go and explore the functionality. Is really cool. And if you have any questions finding it, just write in to support@endowus.com, and we will help you to find it and use it if you want. And another thing to mention is both of the funds that Ross and Alex have talked to, so the Aberdeen Global Dynamic Dividend Fund and JP Morgan Emerging Markets Dividend Fund, are available on our platform, and including the distributing share classes. So yeah, if you're interested, you can also kind of explore on our platform as well. The next question is related to recession fears, I would say. I think we kind of talked to it, but I guess this one is more forward-looking. Someone asked, will dividends be cut significantly given a possible global recession and earnings deterioration? Ross, do you want to start us off? Because it's more on global kind of market, I guess.
Yeah, that's a good question. In all probability, yes. Inflation fears could hit earnings and could hit cash flows. And so then that may mean that companies may reduce or stop paying their dividend. But, you just even pointed out earlier, companies, I think, if they're well managed, well governed, and from an ESG perspective, wanting to keep their shareholders happy as well, they will continue to pay a dividend, and hopefully that dividend is sustainable as well. We look at this from a global perspective, and we know that globally, thousands of companies are paying their dividends, and they've continued. And, the evidence that we showed in the presentation showed there has been robustness of dividends over the period. You can see quarter on quarter that that resilience has remained even during the worst of COVID. So yes, while there might be some slight reduction, and recessionary fears are obviously something that is looked at, companies en masse are not going to stop paying dividends. So for funds like these, there's definitely the ability to invest in companies which will continue to pay dividends. You talked as well about you need the experience, you need the management team that's sitting behind it to be able to find these companies that will continue to pay. So we're aware of the recessionary fears, but we are not concerned about it for this particular strategy. We know that companies will continue to pay dividends. Alex, I'm not sure if you have anything to add to that.
No, that was very, very well put. Through COVID, we have a test case, which is we were able to divide up the world into companies where we were more or less confident about earnings, about their dividend policy, and their determination to keep on paying either a payout of earnings, in which case you're your earnings path matters, or to have a dividend policy which in absolute terms would be stable. And I think we did a good job of navigating through that period. Now, COVID was slightly strange because actually growth stocks outperformed due to an economic contraction because we were all forced to stay at home and conduct our lives on screens. But the way that dividends worked in our portfolio was really quite what we wanted. And I think if we go into a steeper downturn now, I still think this will be the safest asset class to be invested in, or the safest equity class, I should say, to be invested in. And the risk of getting out and trying to be too smart about timing it is I will guarantee you'll miss the upswing on the other side of it as well. So I think that this is absolutely not the most dangerous part of your portfolio.
Thanks for the comments. Of course, we can't really predict the future, but I guess if the recession comes, there will still be good companies that can continue reward their shareholders with dividends. Yeah, and it's just whether you have the ability to spot those stocks and keep invested, I guess. And there is a very popular upvoted question that is higher income and future income, do they behave more like stocks or bonds? A very interesting question because they are essentially a combination of stocks and bonds. So they would behave like that. And in normal times, I think they by right should be rather diversifying to each other. So, 75% of the time, stocks and bonds, they don't move in the same direction. But unfortunately, this year, it's a very rare year. Both stocks and bonds are down. And therefore, the portfolio is, kind of like stocks. And actually, if you look at fixed income market, it's also like fixed income. But I would say one important thing to note is the income stream of the portfolio. I would say it will behave more like bonds, meaning that it will pay a stable income every month on a regular basis, just like how bonds behave. So bonds will pay, stable coupon, right, on a regular basis. Yeah, so I hope that answers your question. And if you have any follow-up questions, feel free to write in. Another question is, I think it's on the Aberdeen fund, because Ross, you mentioned 6.5% yield. They're asking whether this is net of fee, and what would a net of fee yield look like for this fund?
Yeah, no, good question. I'm following Slido as well, so I saw that one. So, with our fund, what we are looking to do is pay a very consistent amount out on a regular basis. So on a dollar-based fund share class, we're looking to pay out 5.25 cents on the dollar, and we want to pay that out consistently. And when I talk as well, it's probably worth pointing out, I never mentioned it earlier, but when we collect the dividends, there's lots of dividend activity, certainly in Europe, round about sort of April, May, June, July. We collect a lot of these dividends at that point, and then we look to equalize and normalize that payment throughout. And so then we are able to continue to pay that 5.25 cents on the dollar on a monthly basis, and that is, you get all of that. So that is net of fees. So the investor gets all of that. I did see another question as well, or did I? Is it gone?
Are you referring to the paying out of capital question?
Yeah, the payout of capital. Yeah, that was a good one. So yeah, that is particular to Aberdeen as well. So I mentioned earlier, we want to avoid paying out of capital. So we have our regular yield from our core portfolio, and we have our dividend capture sleeve as well, which is there to drive a lot of the dividends received. And it is out of the combination of these two that we look to pay this regular yield to our investors. So we want to do this without affecting capital where we can, and we want to pay this primarily out of income received. So we work very hard to do that. And hopefully that addresses a couple of the questions you had there, Yulin, on Slido.
No, that's fantastic. I was going to this. I think this is a very, very good approach, because I look at a lot of funds in my day-to-day, and there are some share classes of the funds that pay out of capital in order to get to that very attractive, very high income level. And we always say that this is not sustainable, and we will not choose any of that kind of funds on our platform. So yeah, it's just something to, I guess, know and to potentially avoid if you are an income investor. I think we are running on the clock, and yeah, and we've addressed all the questions on Slido. Thank you so much, both of you, Ross and Alex, for your time today.
Thank you very much.
Yes, and thank you, Yulin. We really appreciate your time letting us speak, and for everybody who joined the call today, we really appreciate it.
Great, thank you. And we hope to have the chance to maybe have you again with us in the future.
I'll look forward to that one.
All right, okay. Bye, and have a good evening, everyone. Thanks for joining us again.
Thanks, everybody. Thank you.
You.
Bye-bye.